Welcome to WMRE's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at WMRE. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. Let's dive into this week's guest.
Thank you. So this week we have with us Patrick McGowan with Sanctuary Wealth. Patrick, thank you for coming on the show.
Thanks for having me. Appreciate it.
So before we kind of dive into it, if you want to just take a minute to, give a little bio and talk a bit about your firm.
Yeah, sure. I'll start talking about Sanctuary Wealth. So Sanctuary Wealth is an RIA and hybrid wealth management practice that serves retail institutional clients, mainly throughout the United States and some globally as well. We are a firm currently, as of today's recording, and every day it honestly grows. It's amazing, but we're at roughly 80 underlying advisor teams that represent approximately 25-ish billion of assets. And so for that community of folks, we obviously were providing them with financial services, but also one thing that's really important to that and unique to that is alternative investments. So my role here is to focus on the among many things, but one thing I'm specifically tasked with is managing and performing due diligence research on alternative investments. And that includes private equity, private real estate, private credit, and some hedge funds as well. And really keeping a very tight framework for due diligence, and then going out and communicating and helping to allocate to managers.
Yeah, so this is a theme that I definitely feel like hearing more of, about the importance or just interest in alts as part of portfolios. Can you talk about why that's such an important part of what you're trying to offer clients?
Yeah, I think a variety of there's a couple of ways to answer that question. I think the way that, in our view, from an allocator's perspective, I believe that there is a lot of reasons why investors should be investing in the private markets versus the public markets. So, and alternatives mainly are very broadly is a broadly defined term, but really a majority of that is really the private markets, or things that are not traded. And so when I think about one example that always kind of comes to mind among the variety of things is the diversification. So, I believe Bain reported that something like 85% of companies in the United States that have over $100 million of revenue. So the cutoff is a pretty high standard. 85% of the companies are private. So only 15% of those companies are actually public. Meaning, if you put that into perspective, you obviously, when you invest, diversification is obviously a principle that everybody on the investing side community understands. And so if you're limiting yourself only to the 3,600, and really, I think there's only 5 names that make up like 40% of the NASDAQ in terms of market cap weighting. You're really not doing. You're really missing out on a lot of diversification benefits. Private markets also, they have other features that private markets managers that are really skilled have that other managers don't. So unlike public markets, where they may, for example, all be competing over the same stocks when they turn on their Bloomberg terminals and to go to buy them, you have to find skilled managers that will go out and speak with private companies and their businesses and the owners and try to negotiate and purchase them. Either it could be different types of strategies. And this is also true on the real estate side. I think we're talking about this on the real estate side. The majority of real estate that's out there is private. It's private negotiation. It's privately negotiated. And so again, you're missing out on a huge swath of just the diversification and the ability for skilled managers to have, real price discovery and sort of, take advantage of it. So it's the last point I'll make on it is, so where that brings us today is where this space has become so interesting in wealth management is that because of the rise of of wealth and the amount of assets that have come into the space, particularly at a firm like Sanctuary, where you're seeing a lot of folks going to the RAA and independent space. We have forged, and given our size, and we have great relationships with really strong private managers on the private real estate, equity, and credit side to have access to these managers and their strategies. So we see everything. And so I think last year we did 400 manager meetings and have really had great opportunities. So I think it's why it's really important that, the reasons I talked about, but also the opportunity here to execute on that. It's here unlike ever before.
Yeah, I feel like I also just in trying to get my own head around it. I mean, yeah, I've covered real estate for a long time, and mostly just from the side of things of what they're buying and selling and the fundamentals of the property markets, but now trying to get a deeper understanding of how, in fact, they are raising their own equity and how they're structuring their funds. And it seems like there's a bit of an evolution, and hearing things about things like interval funds or, or just the latest generation of non-traded REITs, which are different than the previous one. But there seems to be a lot of different kinds of structures now. Even when you're talking about private real estate, it can get very different depending on what kind of property type you're looking at, but also what kind of fund structure. So that does seem like a lot of stuff you have to kind of parse through here.
Yeah, it is a big part of it. And I think what has happened, without diving into every structure here, because I think you touched on whether it's a private REIT, a public but non-traded REIT,
right,
or an interval fund, or just a traded REIT. The big difference between a lot of those types of structures are what kind of investors can go in them and how often are they traded, and also what's the leverage that they can use. But another point that's really advanced in this space is as more blue chip institutional managers have come into the space, or in other terms, there are managers or world-class organizations that are both operators and fund managers.
Mm-hmm.
So you may look at, I won't say any names in particular, but previously you would have these funds come into the retail space, and the institutional investors knew this, but they would get around it. But retail hadn't quite had the weight that it does now, and they would come to the retail space, raise a fund, and they would charge their 1 in 20 or whatever it would be, management fee and incentive fee, but then also be the operator / asset manager of the buildings and charge other fees or other types of expenses, acquisition fees, and be externally managed, which is kind of what the lingo is it would be managed, but then externally managed by a different advisor, owned by the same people. So there were a lot of fees. If you look at that today, all of it's internalized. If you look at good managers, you ask if a lot of it is internalized, where those fees go. A lot of the good products today, not only are they more accessible to retail, but also a lot of those fees are very investor friendly. So it's really fascinating when you start to dig into it and you look through. Products now are very, very good.
And what about, just we're sitting at a time where I think there's a lot of I don't know, maybe I shouldn't say hyperventilating, but a lot of concern about real estate and with the whole regional bank thing and the stuff about redemption requests from certain entities. How do you, I'm sure that then generates questions from investors about what's really going on. So how do you deal with those kind of, moments like this and dealing with those questions and those kind of conversations?
Yeah, right. Well, look, I think like with anything, when there's a danger, there's always some sort of an opportunity, and sort of how in the headlines are certainly they're never factually incorrect, but they sometimes are when you put into the context, where how bad could it be. And honestly, my one of the managers that we work closely with, I think I was talking to recently, and I think that because of the shocks of 2008 that many of us lived through, there is a bit of an emotional still attachment there too. And so when people see and talk about concepts about how the market could have a downturn or cap rates rising or defaults or going through cycles that are kind of normal, that we haven't seen in a long time. They kind of attribute it back to 2008 and that feeling of what happened then. And they see banks go under, or they see, things that look and feel like that did back then. And they are assuming that that's going to be what's going to happen. And they're kind of just waiting. So I think in reality, we don't have that outlook. I think generally speaking, it does depend a little bit, but real estate and we can go into the details, but we believe that real estate provides the underlying asset itself and how you manifest that trade, whether it's through equity or credit, as we could talk about. But real estate is benefiting from some of the secular trends and the tight supply. And if you focus on quality locations and things like last mile products, we could talk about different verticals, but it does have that inflation protection, that inflation, hedge to it, diversification, and this performance, the strong performance the last couple of years is probably tapering. And obviously with the aggressive central bank tightening, it's led to higher rates, and that is putting pressure, particularly we've talked about on the commercial real estate side, but it's amazing to see how it allows investors to be very selective. And so we could talk about what that selection looks like, what we like, but I would say that so far at our end, we haven't really seen any, we sort of cut through the headlines to kind of have a analytical approach to it.
Right. I mean, I think a lot of it is getting caught up in the office sector, which is the most challenged and for various reasons. But then it's kind of it's sort of then glossing over the fact that other sectors are not being affected nearly in that kind of a way. And a lot of them have very strong fundamentals. So if you want to, just avoid dealing with that one sector, that it seems extreme to then draw to tar the entire commercial real estate universe with the same brush, just because of what's happening in one particular segment.
Well, of course, yeah, I think that is like sort of an observation that I think is true, and I think office is cyclical. And our investors, when you look at the sort of, and this is where it gets into the underlying products and funds, like when you look at different types of funds, like some of the larger core diversified funds, I'll get into some of the stuff that I think we like, but office is, as far as the Odyssey benchmark goes, I think it's 22%, industrial is like 33, multifamily is 28. And I think that, and again, my numbers, depending upon where, when this comes out and my data, but it's within the last sort of 6 months, it's very important. We think there will be, some issues with office, particularly on the debt side and in cities where people aren't really going back into the office, and maybe the leases are coming up. But, I think when we could talk about some of the stats on that, but, it is a portion of the index, and this is just speaking to core, but a lot of the products that are out there with the savvier managers, while there are some other interesting opportunities, even the sort of basic beta-like exposure to private real estate, a lot of those folks are underweight office. So it doesn't really, that doesn't really keep us up at night quite as much, I would say.
Okay.
Yeah.
And so, and when you're looking, is it by that kind of core plus value add opportunity, that sort of a matrix in terms of looking at different funds?
Yeah. I mean, it does. It's core, but then it's also, I would say, it's core / like proper. We sort of look at property types the same way you may look at like in themes and non-core. And I think when you get into whether we're doing ground up versus development and things like that, it gets nichier. But I do think like in this market, of course, like something like industrial logistics or rental housing or healthcare are really interesting, have interesting drivers right now, like industrial logistics, obviously with e-commerce and transportation costs, and there are some constraints, but rental housing, obviously high home prices have made it more attractive to rent. So rental housing is pretty interesting, and you want to emphasize resilient markets with better supply constraints. So healthcare, there's expanding. We see a lot in the life sciences research areas, senior housing, medical offices. These are themes that and I'm sure you know how much you follow the space. I think that these are some of the themes that everybody is talking about. They are there, and the headlines of what's out there in the news is about office real estate in San Francisco, and I just don't think that that's really what when we invest, you really have to be analytical about it. And then the other thing I would say is on the debt to equity side, like the capital
Yeah, I was going to
structure.
ask about that.
And we can talk about that next, but that's certainly that's as far as the sectors we think about core, and then the subsectors within it.
Okay. Yeah, and then so if you want to just your thought was going there, so if you want to just talk about the debt equity picture.
Well, look, I think a lot of, I would say the main theme, like as far as today goes, if you like those underlying assets for the reasons I described, and this is just sort of a lot of the research that I read through some major consultants and stuff, you can express that by putting equity in. But at this time, given the way rates have moved out, you can step in on the debt side, and you can lend and enjoy higher spreads and have greater selectivity across the risk spectrum. To your point before, some banks may be lending or reduce their lending due to uncertainty, or maybe they have some other, capital constraint issues. And so you see private lenders, private real estate focused lenders, opportunistic credit managers, asset-based lenders coming into this space and earning low teens returns, which is kind of like the target return you're going for in this space. First lien, senior secured, and that's without getting into like mezz and other types of debt that are under that. And then there's also a major opportunity in this coming commercial real estate maturity wave that's coming in the next year or two.
Right. So you're getting like equity like returns on debt.
Yeah, exactly. Right. It's a far more conservative approach but still having the conviction around real estate, but expressing it, through lending. And it didn't make as much sense when rates were at zero.
Right.
But with 500 basis points of spread, of widening, it's really interesting.
Yeah, that's why I feel like it's like, just again from my seat, interesting to sort of see how this plays out, because I mean, I don't know if all alternative lenders will come in and fully be able to replace whatever banks have to fall back on, but there's something there that's fun, and that makes this a fundamentally different kind of period than 2008. Like when there were a lot of more like financial systemic issues, and also a lot of really bad debt floating around on the commercial real estate side. And I think that we're just like in a very different moment. So I understand what you're saying about like why everyone would kind of just, their reference point might be this most recent thing that happened, but it just feels like we're not really in that kind of a cycle again. We're just in where real estate goes through cycles. I'm been covering it long enough to have gone through some before 2008 as well. So I feel like, it should be an interesting time.
Yeah, look, and I think like in the U.S., there are some interesting places to be, as I said, in those sectors. And then there are some, I think there will be, as we talked about on the equity side, where you may not want to be on, or on the debt side. I think, everyone's talking about this wave of commercial real estate coming due on the debt side in the next year or two. And some of these buildings that were made, had loans out at 60% LTVs, or however they were underwritten in these major metropolitan areas where everyone has left, their leases and maturities are coming due, I should say, and they have to refinance that debt as the building owner, and the tenants may or may not be there to support that. And not only that, when they go to re-underwrite the loan, value, the L in the LTV may have to be re-underwritten. And so to keep that 60% or 50% LTV, there's going to need somebody to come in and step in and provide additional equity to maintain that level. And who really wants to step in and do that if you can lend at double digits? So I think it's going to be a lot of the sort of like banks own a lot of that stuff. I think that ultimately it's going to be a huge fortune that will be made for a lot of the private real estate lenders out there. And again, as I said, there's, you know, in our space, we've talked to some really good real estate credit, like multi-billion-dollar world-class global organizations that are there and kind of waiting. So I think it's going to be great.
And I think gets back to something you were talking about before too, that you're meeting with, I think you said 400, you know, that's not all real estate, but that includes real estate, but you're meeting with folks all of the time to really vet this stuff. So you're not, you know, and I imagine that some of that is folks that you are proactively investigating or doing your due diligence on, as well as folks that are maybe trying to knock on your door.
Yeah, that's correct. Yeah, I mean, we are, you know, we essentially have in the wealth space, I should say, and in our space, we have institutional and we have retail clients. So, you know, for your wealth clients, we look at the different types of, you know, let's just focus on where we have higher conviction. As I said, it was like on the credit side and these certain particular sectors, but you can access those through these different structures. Or we in the beginning of our conversation, we talked about. So we meet with managers and we keep a few spaces open for those sectors where we have high conviction, but we may have an interval fund, or we may have a non-traded REIT, and then we may have a drawdown traditional institutional QP vehicle that is distressed and or is, you know, just core, like a core Odyssey fund. So we keep something for every kind of type of investor, and it is just it's our job to do that and constantly meet with them. We have to meet with them and do on-sites annually and write our due diligence memos on an ongoing basis. So it's what drives, I think, it allows us to be, I think, successful in at least avoiding some major issues.
Yeah, and what about, I guess, one other area is the idea of tax advantage structures. You know, things like DSTs or opportunity zones funds are like, and how do those fit into when you're assessing opportunities?
Well, so they fit in a lot. So it's something that we you know, those structures are always on the forefront of really the sort of, you know, what's going on in discussions around Washington and these tax, you know, structures and how beneficial they've been, and every year, a couple of years, there's always rumors about whether they're going to continue or they're going to stay. Right. And I sit on a lot of these sort of organizations or talk to a lot of these organizations that try to stay close to Washington to figure out what's going on, and so that's one part of it is just like, you know, staying on top of what's going on there. Now, as far as, you know, in our world, like, we have real life events, and as do corporations, where they're selling properties and buying new properties, whether it's because of a life event or a corporate event or whatever. And, you know, these are, you need to use these. If you have a good advisor with you, they're going to tell you need to use these, or else you're just at a disadvantage. So when we look at it, we'll look at a manager and we'll look at their fund, for example. Let's say, you know, they're going to do some 1031s, or they're going to basically, with that, you know, essentially when you sell a property, you have something like 45 days to identify a new property, 180 days to contribute to a new property and close. So we look at, you know, some of the stuff that might be what they're going to 1031 into, but what we do is we take it the entire history of that they've done in the past and what they do, and you'll see it's a very repeatable process and track record about what they do and the types of buildings they're doing. You know, opportunity zone funds seem more developmental. They're meaning on the development side, whereas on 1031 it's more like fully stabilized properties you can buy, or you see a lot of triple net lease stuff. Those are both good. And on the opportunity zone fund side, there's really interesting opportunities where people do things like pre-TCO investments, which is like buildings are still in the development stage, but they're very, very close to almost being finalized, and they have a good idea of how it's going to rent out. So you can de-risk a lot of that as well if you work with some of these really good global managers. And I would say if this was 5 or 10 years ago, we probably wouldn't have as many, global blue chip brands to kind of work with that we know can execute. So I think we can de-risk a lot of that.
I just wanted to give you a chance, though, if you had any, last thoughts that you wanted to share, or anything that didn't ask you about that you thought might be good to underscore before we wrap things up.
Oh, no, I mean, I appreciate this is a really great forum to explore these concepts. And here at if anybody has questions or reach out, they're welcome to reach out to us or anybody at Sanctuary. So I appreciate you doing this and everything you're doing. And I think it's, this education is key. And so no, just, thank you for going out here and doing this.
Thank you. Well, thank you so much for your time. And
yeah,
it's always great talking to you.
Great. Same here.
Thank you for listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe button below. This way, when David comes out with a new podcast, it will show up directly on your listening device. We humbly ask that you share this podcast, rate it, and leave a review, as this actually helps others find the show. Again, thanks for listening today. For everyone at WMRE, this is Wendy McConnell, inviting you back in 2 weeks for all the stories that matter to you. We'll talk soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of WMRE or Informa. The content has been made available for informational and educational purposes only.